Welcome to The Explainer. Today, we're going to unpack a pretty fascinating corporate mystery together. Alibaba is set to report its highly anticipated earnings on August 20th. And if you've been following this tech giant, or honestly, even just looking at the broader market recently, you know the stock has seen a pretty rough 16% decline year to date. But when we actually pop the hood and look closer at the business metrics, that stock chart doesn't quite tell the whole story. We're looking at a massive, complex puzzle where, at first glance, the pieces just do not seem to fit together at all. You see, when you look at Alibaba right now, the surface numbers are incredibly conflicting. On one hand, you've got this narrative of explosive, futuristic growth. But on the other hand, you've got traditional financial metrics that are flashing bright red warning signs. It forces us to ask a very direct question. Are we witnessing a brilliant turnaround story where a legacy tech giant successfully reinvents itself for the future? Or are we looking at a complete profit meltdown?
Now, what's really interesting about this slide is the direct clash between brilliant top-line growth and terrifying bottom-line realities. On the revenue front, overall numbers are up 8%, and their cloud division growth is accelerating to 45%. Their AI models have even surpassed a staggering 3 billion downloads. That sounds like a company completely dominating its sector, right? But then, contrast that with the core financials. Adjusted earnings per share is expected to drop by 27%. Free cash flow, it literally just went negative. Operating profit actually swung to a loss. It is incredibly rare to see a company growing its future-facing divisions this fast, while simultaneously watching its core profitability fall off a cliff.
To help make sense of all this noise, here is our roadmap for today. First, we'll look at the core paradox, AI bet or profit trap. Second, the aggressive AI pivot. Third, the ugly profit reality. Fourth, why Wall Street is bullish. And finally, 3 things to watch on earnings day.
Number 1, AI bet or profit trap.
Number 2, the aggressive AI pivot.
Okay, let's dive into this because to kick things off, we really need to understand the overarching framework of Alibaba's current strategy. The company is essentially operating in 2 different realities at exactly the same time. Management isn't just dipping their toes into artificial intelligence. They're making a massive, deliberate, and highly structured bet on a cloud computing future. And to understand the true scale of this pivot, you have to look at this number, $100 billion. To put that into perspective, that's roughly the entire GDP of a small country. And its CEO Eddie Wu's staggering goal for annual cloud and AI revenue within the next 5 years. Alibaba's current annualized cloud revenue sits at roughly $25 billion. So they aren't just asking for incremental growth here. They are targeting a massive 4x leap from where they are today to fundamentally rewrite the DNA of the company.
And you know what the wildest part is? On the top line, this pivot is actually working. Cloud revenue growth has accelerated to 40% year over year. Even more impressive, their AI-related products have delivered triple-digit growth for 11 consecutive quarters. Guys, that's almost 3 years of sustained, explosive expansion. On top of that, Model Studio, which is their primary AI platform for developers, saw its customer base grow 8-fold. They are rapidly locking in the developers who are going to build the future of the Chinese internet.
The sheer scale of their reach is almost hard to wrap your head around. Surpassing 3 billion downloads makes their Qwen AI models one of the most adopted open-source model families anywhere on the globe. CEO Eddie Wu has explicitly called this current moment the turning point for AI and cloud commercialization. In fact, because of this massive adoption rate, management expects AI-related products to exceed 50% of total cloud revenue within about a year.
Number 3, the ugly profit reality. Now, prepare for a little narrative whiplash, because we have to pivot abruptly from those exciting AI headlines to the brutal cost of funding these ambitions. Building the future of artificial intelligence is not cheap, and the financial toll it's taking on Alibaba's present-day balance sheet is severe. In their last reported quarter alone, Alibaba spent $3.9 billion in capital expenditures, specifically to expand their AI and cloud infrastructure. Just let that sink in for a second. Almost $4 billion in a single quarter. That breaks down to roughly $43 million spent every single day. That massive outlay entirely wiped out their free cash flow, sending it negative by $2.51 billion. Consequently, their adjusted EBITDA dropped by an astonishing 84%. They are literally draining their current cash reserves to buy the computing power required for tomorrow. And this brilliantly illustrates where the story gets super tense for investors. Despite all the AI hype and the billions being poured into data centers, a massive 65% of Alibaba's revenue is still tied directly to their traditional China e-commerce business. And that core business, it is under intense pressure.
They are fighting weak consumer demand, rising competition from rivals, and they're having to aggressively subsidize their quick commerce initiatives just to maintain their market share. Because they are fighting a war on two fronts, investing heavily to lead in AI while simultaneously trying to defend their core e-commerce market. The upcoming earnings expectations are, quite frankly, brutal. Look at these squeezed margins. While revenue is expected to climb 6.3% to almost 269 billion RMB, adjusted EPS is slated to plummet 31%, and EBIT is expected to crater by 44%. It is a deeply painful transition period for the company's ledger.
Number 4, why Wall Street is bullish.
So the crucial point is this. Given the negative cash flow and the plummeting profits we just walked through, you would expect analysts to be running for the exits. But they aren't. In fact, out of 50 major Wall Street analysts covering the stock, 47 rated a buy with an average price target of $190.76. That implies roughly a 56% upside from current levels. Why? Well, it all comes down to categorization. Right now, the market is starting to value Alibaba less like a traditional retailer and more like an AI and cloud platform. Notice the Amazon forward earnings multiple sitting up there at 27x. Alibaba, despite its massive cloud footprint, is trading at roughly 15x. If Alibaba successfully proves that its AI and cloud divisions are the true engines of its future, the market could apply a tech multiple rather than a retail multiple, creating some massive re-rating potential for the stock. Furthermore, the underlying expectations from the smart money are actually quite conservative. Morgan Stanley sees cloud revenue growing 45% year over year, with margins improving to around 11%. Barclays expects AI annual recurring revenue to beat current targets. And perhaps most importantly for that cash bleed we talked about, those heavy quick commerce losses in their retail division are projected to have by fiscal 2027 and break even by 2029. CMBI even explicitly called Alibaba a key beneficiary of the AI theme. If those retail losses shrink, it frees up massive amounts of cash to continue funding the AI war. For anyone watching this stock, this is the exact thesis you are buying into. Short-term retail pain for long-term tech multiples.
Let's move to and see how this builds into number 5, 3 things to watch.
We've seen the paradox, the insane spending, and the bullish thesis. Now, let's synthesize everything into a precise, actionable checklist for earnings day. When those numbers drop, ignore the noise and look directly at these 3 metrics. First up, cloud margins. Previews suggest cloud EBITDA margins could improve from 9% to low double digits. If they hit that, the AI re-rating thesis gets much stronger. If they miss, the market is going to punish them. Second, core e-commerce stability. We need to see China e-commerce margins climbing back toward 25%. Even with AI booming, if the core business bleeds too fast, the whole story completely falls apart. Third, capital expenditure guidance. Management noted that AI compute demand increased tenfold since 2022. Investors desperately need clarity on whether the worst of the spending cycle is behind them or if this multi-billion-dollar capex strain will continue all the way through 2027.
And from a market mechanics standpoint, you might want to brace for impact. The options market is currently pricing in a 6.6% move in either direction immediately following the report. Technically, key support levels are sitting right around $119 or $114. If the market dislikes the margin story or the capex guidance, and the stock breaks below that $110 floor, the technical picture shifts violently downward.
And that brings us to the ultimate question you have to answer for yourself. Alibaba is making a highly calculated, incredibly expensive bet that owning the AI and cloud computing market in China is entirely worth sacrificing their present-day profits. The top line is booming, the bottom line is bleeding, and Wall Street genuinely thinks the long-term math works out in their favor. So the only question left is, do you trust management's timeline? Keep an eye on those margins. And thank you so much for joining me for this explainer. Keep learning.